Bernie Madoff didn't rob a bank, he robbed trust. And for nearly 40 years, the smartest people in the room helped him do it by not asking the right questions. Imagine this. You open your account statement. Month after month, year after year, your money goes up. 5%, 8%, 12%. Barely any losses. Through dot-com crashes, through recessions, through chaos. Your friends lose money. You don't. You feel lucky, you feel smart, you feel safe. Now imagine this. All of that profit never existed. Today we're unpacking how Bernie Madoff went from respected Wall Street royalty to the face of the biggest financial fraud in history. Not just how he lied, but how the system around him made it incredibly easy. So why does this story still matter? Long after Madoff died in prison in 2021? Because what he did wasn't sci-fi. He didn't hack computers, he didn't invent exotic crypto tokens, he used paper, charm, and people's fear of missing out. The same human weaknesses that drive financial manias now. If you understand how Madoff pulled this off, you understand how too good to be true returns really work, why smart, wealthy, educated people fall for obvious schemes, and how entire institutions can look at the same red flags, stand collectively shrugged. This isn't just about one man, it's about a system that preferred comfort over questions. Let's start with the simple version. What did Bernie Madoff tell people he was doing? He said he had a special strategy. Very calm, very safe, nothing crazy. The story. He was using something called a split strike conversion strategy. Sounds technical, in plain English, it's this. Step 1. Buy a basket of big, safe stocks. Think of the big names in the stock market, household brands. Step 2. To protect the downside, buy options, basically insurance contracts that make money if the market drops. Step 3. To earn a little extra, sell other options to collect small, steady income. The sales pitch. Not get rich quick. It was never lose big, slow, steady, safe. And that was the genius of the lie. He didn't promise 1,000% returns. He promised boring returns. The kind that feel grown-up, responsible, conservative. On paper, that strategy can work. In reality, it's messy. Returns go up and down, you win some months, lose others. The line is bumpy. Madoff's line was not bumpy. His returns looked like a ruler, smooth, predictable, barely any red. That's the first uncomfortable truth. In real markets, perfectly smooth is not a sign of genius. It's a sign that something is being made up. So what was he actually doing? Underneath the fancy explanation, the core mechanism was brutally simple. It was a classic Ponzi scheme. A Ponzi scheme is like this. You tell person A, give me your money, I'll invest it. You don't invest it, you keep it. Then you tell person B the same thing. You use person B's money to pay returns to person A. Their account statement shows profit. They're happy. They tell their friends, more money comes in, no real profits, just money moving from new investors to old investors. As long as more money flows in than flows out, the illusion holds. Madoff did this at industrial scale. He took in billions from individuals, hedge funds, banks, charities, even foundations that supported Holocaust survivors. He used new money to pay old promises, and he printed fake account statements that looked extremely real. The math was the real crime scene. The size of the money he claimed to manage, the trades he claimed to make, and the actual capacity of the market to absorb those trades. If anyone had seriously checked that math early on, the illusion would have cracked. Let's put some shape on his life. Bernie Madoff started Madoff Securities in 1960 with just $5,000, some of it from working as a lifeguard. He wasn't a nobody. Over time, he became a genuine player in the legitimate side of the market. His firm helped pioneer electronic trading. He became a major market maker, basically a middleman matching buyers and sellers of stocks and making small profits on each trade. This part was real. Big banks and institutions actually used his firm to route their stock orders. He even became chairman of the Nasdaq Stock Exchange in the early 1990s. That's important. His public reputation wasn't shady operator, it was trusted elder statesman of Wall Street. Behind that, in a separate part of the business, he ran the secret investment advisory operation, the Ponzi machine. It was like he had two identities, the respected market innovator on the surface, the quiet operator promising magic returns to a select group behind the scenes. And a lot of people were desperate to get into that second door. One of the strangest parts of the Madoff story is how exclusive the fraud felt. Many investors didn't stumble onto him through slick ads. They heard about him through whispers. Golf clubs, country clubs, synagogues, social circles in New York, Florida, and Europe. The psychology was clever. He didn't pitch himself as "I'm looking for clients." He let people feel like they were lucky to be invited. If you asked too many questions, he could act offended. He might say he was full and didn't need more money. That made people want in even more. Feeding a basic human impulse, if it's hard to access, it must be good. He also tapped into trust networks. People invested because my friend is in, or this foundation, uses him, or this bank put money with him, so it must be safe. Madoff understood something powerful. People don't just trust numbers. They trust who they think is standing behind the numbers. Let's talk about the hidden mechanism, the paperwork. The illusion didn't live on screens. It lived on statements. Every month or quarter, investors got neatly printed account summaries. They showed what stocks had been bought and sold, what options had been traded, the exact profit made. The layout mimicked real brokerage statements. Behind the scenes, many of those trades never happened. There were no actual positions in those stocks or options, at least not at the scale shown. It was financial fan fiction, printed on high-quality paper. When clients wanted to withdraw money, Madoff would use new incoming funds to pay them. If they didn't ask to withdraw, their account just kept growing. He exploited one quiet fact. Most people don't cross-check their statements with the actual underlying market data, and many institutions outsourced that thinking to others. That's where the system failed. Because here's the uncomfortable part. There were warnings. For years, a financial analyst named Harry Markopoulos and a small team tried to alert regulators that Madoff's numbers were mathematically impossible. They didn't just feel wrong, they didn't add up. Markopoulos reverse-engineered the claimed strategy and returns. He looked at the consistency of gains, the size of the trades Madoff would have needed to make, the actual trading volume in options markets. The conclusion: if Madoff was really doing what he claimed, you would see it in the market. There weren't enough options trading to support the volume he implied. He submitted detailed memos to regulators saying, in essence, this guy is a fraud. The math proves it. Nothing serious happened for years. Why? Because the story around Madoff was so comforting. He was a former NASDAQ chairman. His firm was established and well-connected. Big banks and funds trusted him. When someone looks that respectable, it's easier to assume the critic is jealous or overreacting. This is where hype beat reality. The story of Bernie Madoff, Wall Street statesman, overpowered the logic of basic numbers. Now layer on the timeline. For decades, the scheme kept going. Then came 2008. The global financial crisis hits. Markets crash, fear explodes. Investors who once let their profits roll start calling, saying, "I want my money back." All of it. In a normal investment fund, this is painful but manageable. You sell assets to raise cash, you take losses. People get upset, but the money is mostly real. In a Ponzi scheme, there is no real portfolio to liquidate, just a hole. In December 2008, Madoff was overwhelmed by withdrawal requests he couldn't meet. The machine needed new money to survive. But when everyone is scared, new money dries up. At that point, the Ponzi physics flipped. For years, new inflows greater than withdrawals. Suddenly, withdrawals greater than new inflows. The engine seized. Madoff reportedly confessed to his sons that the investment advisory business was one big lie. His sons turned him in. The scheme collapsed publicly. Estimates of the total fraud are often quoted at around $65 billion in supposed account values, money people thought they had. But the actual net cash lost, the real money put in minus what was taken out, was in the tens of billions, still staggering. The victims were not just greedy rich people, they included retirees who trusted friends' advice, charities and foundations that suddenly had their lifeblood wiped out, pension funds and institutional investors who thought they were being conservative. Many weren't chasing wild riches, they were trying to protect savings. That's what made the betrayal feel deeper. And this is where irony creeps in. Wall Street has always sold the idea that you can manage risk with the right strategies. Madoff sold the ultimate safety fantasy and used it to deliver maximum risk, total loss. So, what are the bigger implications? First, Madoff showed that reputation can be a form of collateral. If your image is strong enough, people will lend you trust instead of asking hard questions. Second, he exposed how fragmented oversight can be. Different regulators looked at different pieces. Nobody assembled the full picture. Everyone assumed someone else had checked. Third, he proved that sophisticated investors are just as vulnerable to basic psychological traps. Fear of missing out on a good thing, relief at seeing stable returns in a volatile world, deference to authority and prestige. The uncomfortable lesson isn't that one man was monstrous. It says that a lot of people and institutions were more comfortable with a soothing story than with messy uncertainty. And that pattern repeats, whether it's in tech bubbles, real estate, or new financial fads. So what should someone take from the Madoff story now? Not paranoia, not trust no one, but a quieter rule. If the returns look smooth when the world is rough, if questions are deflected instead of answered, if access feels like a privilege rather than a service, then it's worth slowing down. As financial products get more complex and the marketing gets slicker, the core risk doesn't change much. It still comes down to, where is the money actually going? Who can verify it? And what happens if everyone asks for their money back at the same time? Bernie Madoff is gone. His scheme is over, but the conditions that allowed it are very much alive. The real question is, in the next great too good to be true story, will anyone listen to the uncomfortable math before the ending writes itself again?